Financial statement analysis is without question, for those of you that are not going to be accounting majors, is the most important takeaway of this course. You need to know, as a functioning business individual, how to look at a set of financial statements and ascertain at least the minimum information that those statements tell you. You should do this before you invest in their stock. You should do this before you start buying a key component of a future manufacturing process that hopefully all of you entrepreneurs have. You should do this before you start selling your goods and services to a publicly traded company. Because nobody makes any money by selling goods and services to a company that's in such financial difficulty that they don't pay you. Right? Bad debt, you might as well just stay in bed that day rather than make that sale. And lastly, you shouldn't go to work for a publicly traded company until you look at their financial statements thoroughly. I'm trying to get you to avoid going to work for Blockbuster, right? Or Radio Shack, or one of a dozen and dozen of companies that are hanging on by a thread. Don't go to work for these people. You can avoid it. And when you get up in management, you can also insist, even with small, closely held corporations, you can insist on seeing their financial statements before you accept a job offer. It's only prudent. I mean, throughout my accounting career, I have worked for a number of small, closely held corporations. And in every instance, I had a set of financial statements that I could look at for a couple of hours uninterrupted before I finished the job interview. And in all that time, I only had one that said no, they wouldn't show it to me until after I came to work. And I went, well, that's going to be a problem because I'm not coming to work. You couldn't pay me enough to show up. So I walked away, got a better job. All right? So know at least, and you'll see here from looking at my video and what I'm going to go over today, getting the basics is not difficult. And it is not something you need to memorize. Learning how to do basic ratio analysis, vertical and horizontal analysis on a set of financial statements, you can look up in less than 0.0003 seconds in Google. They'll show you how to calculate it. All right? Which is why, for the final exam, it's open book, open note. Because I don't expect you to memorize how to do this. Okay? So let's start with some basics. On page 742, 743, we've got problem 15-4A. What did they say? 742. On here it says, comparative financial statements for Bantacorp, Inc. are as follows. The market price of their common stock was $71.25 on December 31st, 2016. And it gives you, for the years ending December 31st, 2016 and 2015, it gives you a comparative retained earnings statement, a comparative income statement, which is multi-step, which you can tell because there is a gross profit, there's income from operations, there's income before income taxes, and there's net income. So it's a multi-step income statement and a classified balance sheet. So it's showing in the asset side, current assets, long-term investments in property, plant, and equipment. 3 of the possible sections in assets. It's got current liabilities and long-term liabilities. And then it has contributed capital, 2 types of stock, as well as retained earnings. And then it's asking you to do 19. I'm not going to do all 19. I'm going to focus on 10, which are the same 10 that I'm going to be focused on for the final and for the extra credit. All right? If you do these 10, you'll get enough information out of the financial statements to be able to make, along with vertical and horizontal analysis, which I'll do here in a second, to make an informed decision as to the financial strength of an entity. All right? And that ultimately is what you want to do. Okay. So the first one, it asks, what is working capital? Well, working capital is simply the current assets, which if you remember from when we were talking about classified balance sheets, current assets are cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up in the next year or an operating cycle, whichever is longer. A year, unless you're making 15-year-old scotch. It's a year. All right? Minus the current liabilities, which is everything that you have due and payable in the next 12 months. So in essence, it's all of the cash that you have, or stuff that you're going to turn into cash, less what you owe. So in this case, current assets equals $1,100,000. All right? Because they have cash, they have marketable securities, what they're going to turn into cash. They have net receivables, what they're going to turn into cash. They have inventories that they're going to sell. And then they've got some prepaid expenses that they're going to use up. They have current liabilities of $440,000. So they have $660,000 in cash that make up, well, not cash, that make up working capital. This is what they have to work with, either to buy more inventory, to invest in a new product line, in a new marketing campaign. This is what they've got to play with. All right? So that's working capital. The second one is a current ratio. That's simply the same 2 numbers divided rather than subtracted. And they have a current ratio of 2.5. Anything above 1 is healthy. If you've got enough cash, what you're going to turn into cash, what you're going to sell and use up to pay your debts as they come due, that's healthy. If you go look at Microsoft or Apple or any of those tech companies, you'll see current ratios in the 15 to 20 sometimes. They've got lots and lots and lots of cash. Okay? So that's your current ratio. Anything above 1, depending upon the industry, is acceptable. The third one is a quick ratio, sometimes called an acid test ratio. The quick ratio, the denominator is the same, current liabilities. Only now you're going to divide it into, if I had to pay all my debts by the end of the week, could I do it? So what can you turn into cash by Friday? Cash. It's already cash. marketable securities you could sell today, and the accounts receivable. You can either call your customers and beg them, a phone call I have made many times in my career. If you want me here on Monday, you've got to pay me today. If you've got a good customer and you get a hold of their controller, don't get a hold of somebody down the line. Get a hold of one that can make the wire transfer. You can make that happen. Otherwise, there's all sorts of firms that will do things called factoring. They'll buy your receivables. You won't get 100%. You'll get a factor of it, depending upon your need. You can turn it into cash. So cash, marketable securities, and receivables. If you add those up for this company, that's $880,000. Because they have $450,000 in cash, they have $300,000 in marketable securities, so that's $750,000, and they've got $130,000 in accounts receivable. That's $880,000. So they have a quick ratio, an acid test ratio of 2.0. That's fantastic. That means they could, in fact, today, sit down and write checks for every dime that they owe over the next year and pay it off. Rare find. If you can get 70 cents on the dollar on a quick ratio, a 0.7, I'd be comfortable with that. Okay? So those are the first three. That's telling you what that this company is. What is all this associated with? What did we say in Chapter 1? 2 overarching goals of a business. One is to make a profit. The second is to do what? To be liquid. And the working capital, current ratio, and acid test, quick ratio, tells you how liquid they are. How much cash do they have to pay their debts as they come due? The next 4, so this is 3 of them, the next 4 are associated with how well do they manage their operating cycle. Does everybody remember what an operating cycle is? Well, I talked about current assets and current liabilities are either 1 year or an operating cycle. So does anybody remember what an operating cycle is? I know it's been weeks since I talked about this. Think it through. Remember the 16-year-old Scotch. It's cash out to cash in. The minute you start spending cash, whether it's paying employees, buying inventory, the minute you start spending cash until your customers pay you. All right? So the operating cycle and the good management of the operating cycle is dependent upon these next 4 ratios. The first one is accounts receivable. It's 4. I skipped one. Number 4. Accounts receivable turnover. How many times during the year do you collect your receivables? The numerator is average receivable. I'm sorry. The numerator is sales. 1.2 million. That's how much you sold during the year. So of that, how much of it is in accounts receivable on average throughout the year? Well, to do that, you take the beginning accounts receivable, which accounts receivable on December 31st, 2015 was $110,000. Add the $130,000 at the end of the year and divide it by 2. And that'll give you the average balance in receivables. So on average, you had $120,000 worth of accounts receivable throughout 2016 on $1.2 million worth of sales. Or you collected your receivables 10 times over. All right? Now, is that a good ratio or a bad ratio?
Good ratio.
It's not a great ratio, but it's not a bad ratio. You collected it 10 times. The next one really gives you some insight, which is the number of days sales in accounts receivable. So that average of 120,000 makes up what? Well, if you take 365 days, 365, and divide it by the ratio that you just calculated, the accounts receivable turnover, you get 36.5 days. So on average, you've got 36 and a half days of receivable balances on your balance sheet. That's not cash. It's what you're going to turn into cash. Now, most companies in the United States have terms of net 30. You're supposed to pay your vendors within 30 days. So if they've got an accounts receivable number of days in accounts receivable of 36, that means their customers are paying a little slow. It's not awful. It's not terrible. But it's not within terms. Okay? And for all I know, maybe this company has 45-day terms. There's no way to know from here. You'd have to go look at the footnotes or do business with them to find that out. All right? In the aerospace business where I came from, on average, most companies pay in about a 60-day cycle. So if you've got less than 60 days of receivables, you're doing all right. All right? If you've got 110, you're doing awful. And you're probably turning the lights off and laying everybody off. I mean, it's not a good thing. All right? So that's the first half of the operating cycle. The second one is inventory turnover, number 6. Just like sales is associated with accounts receivable, inventory is associated with cost of goods sold. So they had $500,000 worth of cost of goods sold. Inventory at the end of the year was $58,000. At the beginning of the year was $67,000. Divide it by 2 is 62,500. If you divide 62,500 into 500,000, you get 8.0. So they turn their inventory over 8 times a year. Now that is highly dependent upon the industry that you're in. For a retailer, like the Gap or Walmart or Target, that would be a terrible number because they're high volume. H-E-B grocery store, terrible number. For Boeing, fantastic number because it takes a long time to build an airplane. All right? So 8 times. So what is that in number of days inventory? Well, take the 365 and now divide it by 8. So they have 45.6 days sales and inventory. All right? That's not something you want at a 7-Eleven. You don't want a month and a half worth of inventory on hand. Okay? All right, here we're going to start going a little bit out of order. Ratio of liabilities to stockholders' equity, number 9. This company has total liabilities of $1,540,000. Total equity of $3,230,000, or 0.5. Now what this shows you is that if everything went south, how much am I, as a creditor, lending money to this company? And that could be because I'm selling them goods and products, so I've got, accounts payable due to me. How much am I at risk versus the owners of the company? And you would always want, if you were a creditor, you would always want the owners to have more skin in the game than you. Right? You'd want them to lose more than you did if the whole company collapsed tomorrow. And in this case, they do. Twice as much. I'm only at risk 50 cents on the dollar compared to the owners. Because the owners elect the board of directors who elects management. They can actually control this beast. I can't. I'm an outsider, whether I'm a bank or a vendor. All right? So this one's critical. How much skin do they have in the game? So what do they earn? Number 14 on stockholders' equity. This one is net income, which for 2016 was $300,000. Divided by average stockholders' equity. So we had $2,955,000 at the beginning of the year. We have this number, $3,230,000 at the end, and we divide it by 2. So this gives you the average amount that the owners have invested in this company, either in their common stock or their retained earnings. And I can't begin to do that one in my head. Somewhere around $3,140,000, something like that. But if you divide that out, this one is 9.7%. That's a really good number. You know, in today's environment, if you get anything up above 5 to 6%, that's a pretty decent return on investment. So, and even double digits would be fantastic. And what I should have done in order was number 10. Number 10 is number of times interest charges are earned. And that's what these people are interested in. When you borrow money, a commercial loan, oftentimes the loan has what are known as loan covenants. Things that must happen during the year for the loan to stay valid. Like you're not, in most cases, allowed to go out and borrow a whole bunch of other money from other sources without notifying the primary creditor. You know, your primary bank doesn't want you to go out and borrow another $60 million from somebody else without telling them first and getting their approval. Well, number of times interest, because what does a banker want at the end of the day? First and foremost, how do they make their money? By you paying interest expense. So this tells them, and what this is it's the income before interest and taxes. Okay? So that's the $446,000 number here. It's not listed. But it's before the interest of $66,000 and before the taxes of $80,000. So it's $446,000. Well, nice catch. Divided by the interest expense of $66,000, or 6.8. So what that says is that what the banker is most interested in, which is getting their $66,000, this company has earned before they pay me, the banker, and before they pay Uncle Sam, the taxes, they have earned 6.8 times as much. That's a nice cushion. You will frequently see that, depending upon your credit risk, somewhere in the 5 to 8 range. They'll say. And if you miss that number, in other words, you lose money to the point that your times interest earned drops below that threshold, let's call it 8 or 7, that's in your loan document, the next day, the banker would pick up the phone and say, send me my money. Your loan is due. It's called. You're done. That's a bad day. Right? Because they normally have assets collateralizing the loan. And when you can't send them the cash, which if you had the cash, you'd have made more money. So it's a bad thing. Okay? Does this make sense to everyone? Okay, those are the 10. It should be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, those are the 10 ratios that I want to emphasize. Now, there's others, but these are the important ones in my mind. And these are the 10 that will be on the extra credit and on the final exam, is to know how to do these 10. Yes?
Would you mind just going over 9, 14, and 10 one time, or just kind of like real quick?
As to what they are or how to calculate them?
Like what the
Or both?
Kind of like both, yeah.
Okay. 9, the calculation is total liabilities divided by total stockholders' equity. All right? So how much do you owe versus how much have you got in the company? All right? This is an indication of risk. So how much skin in the game does the owners of this corporation have in the corporation itself? All right? And they've got twice as much as they've borrowed. Very healthy. All right? So that's that one. If that was upside down, In other words, it was 2. They owe twice as much of what the owners have in, then this number becomes more important. Because what are the creditors interested in? They're interested in their interest payment. And this one is earnings before interest and taxes. Okay? Earnings before interest and taxes. So that's net income plus income tax expense plus interest expense. Divided by the interest expense. This one is, okay, the owners don't have a whole lot at risk, but what kind of return? So if you're a banker and this number was bad and this number was huge, right? In other words, they're getting huge returns on the amount of money that the owners have invested, then you probably need to go back to the table and renegotiate your loans because you're getting a bad deal. All right? Because 1, they're way over leveraged, and 2, all of the good side, the upside, is going to the owners, not to us as the creditors. Okay?
Okay, that makes sense.
All right? Okay. Let's turn the projector on. I'm going to turn this off.